Hi, my name is Willy, and welcome to part 2 of a 4-part series of inflation, interest rates, and the economy. In part 2, we're going to dive in deeper and look at how inflation and interest rate actually become mortal enemy. So stay tuned for more. Now, let's take a short recap on what we have actually learned in our part 1. How actually interest rates influence the economy itself? Well, it actually influences 3 main factors. One, which is the employment market. And in a short way of explaining, how well is the employment market working? Is there very high unemployment or a lot of people got their jobs? Number 2 will be businesses. Businesses in terms of their business activity and also output. Is their business activity quite high or is it going down? And number 3 is us in terms of consumers. How well is the consumer market itself in terms of spending their money, or there's a lot of consumers which actually deposits their money and opt for savings instead. So after knowing this, we're going to move on to the next part where we dive in deeper about inflation and interest rates. Now, since you got a gist on how interest rate actually influences the economy, we're going to look at its main mortal enemy, which is inflation. But what exactly is inflation? I guess a lot of us has stumbled upon this word itself post-pandemic. It has become a very hot topic nowadays due to what is going on everywhere else in the whole world. Inflation itself is actually known as the rising price of goods. Price of goods are in terms of our daily goods, such as our meals or baby powder that we bought from the grocery and fruits. So inflation itself actually diminishes buying power. When inflation is getting higher, the amount of goods that we could actually buy with $100 now is not the same as the amount of goods that we can buy before the pandemic happens or before the inflation spike. Now, there's one thing about inflation is that it could play 2 ways. Inflation can be good to the economy and it could be bad for the economy. Now, we're going to look into this even deeper after this, but let's look at the second scenario whereby inflation is actually getting worse right now, which could actually be bad for all of us. If inflation is not being controlled, or in a sense whereby it keeps rising rapidly, now it could actually lead to our wages couldn't keep up with the current rise in the prices of goods that we buy every single day. This will actually erode us even further because we could not afford what we can afford before the inflation spike happens. And not only that, inflation could also erode the monetary value of the currency itself. As the price of goods getting higher, the amount of money that we need to spend to get the same goods as before the inflation rise is going to be higher. Thus, it will actually decreases the value of our money in the future. And not only that, as inflation rises, we might stumble upon unemployment rate getting higher as well. We will actually explain even further after that. But in terms of uncontrolled inflation, it could lead to 2 things. 1, it may lead to stagflation or it may lead to hyperinflation depending on which economic situation that we are currently in. So we're going to dive in deeper and see what actually is stagflation and also hyperinflation. First of all, let's look at stagflation. Stagflation is a combination of 2 words, stagnant and inflation. But why do we put stagnant at the front? Now, stagflation actually occurs when the economic growth is actually going down, whereby it is getting worse. However, at the same time, it is where the inflation is actually getting higher, but concurrently, unemployment increases as well. This whole economic setting is known as stagflation. But what could actually lead to stagflation? Now, one of the causes is due to supply shock. This is actually currently happening right now, whereby we are actually experiencing some degree of supply shock. Supply shock could actually lead to sudden price increase due to high demand in the market because our demand is too high that the supplier could not supply enough inventories for all of us to buy, and thus it could actually lead to businesses increase their price in order to gain more money, of course. But at the same time, it is due to demand getting too high, whereby the supply is currently running low. Now, the second cause to this is due to poor policy from the government or the central bank. One of the ways that they could lead to stagflation in terms of the government is whereby they spend too much money, spending in terms of reducing taxes or increased payouts and so on. And in terms of central bank, they might not be able to increase interest rate fast enough in order to control the economic situation and thus leading to stagflation. Now, stagflation is one of the more of a rare cases to happen, but right now, as of 2022, whereby this video is being recorded, there are certain signs whereby stagflation might occur. Because in terms of the recent economic data, we could actually see that economic growth has subsided. This is due to a reduction in terms of business activity and also output. And at the same time, the inflation is actually a tad too high right now, even though we have done a lot of, actions in order to control it. But at the same time, unemployment starts to hike up slightly. Although we are not very near to stagflation, but if all of this is not being controlled, then stagflation may occur in the near future. So now let's look at what actually is a hyperinflation. Now, what actually is a hyperinflation? Hyperinflation is a scenario whereby the price of goods actually rises significantly or rapidly in a short period of time. And due to the rise of price of goods in a rather short period of time, but in a rapid sense, this could actually lead to a loss of faith towards the local currency. Because more currency is needed to buy a single good, it has become to a tendency whereby you might need to bring up a bulk of currency in order to buy something which is actually quite small in monetary value previously before hyperinflation actually occurs. Now, in terms of hyperinflation, what could actually happen to the economy is whereby the unemployment is expected to increase. And not only that, companies may run out of business because price of goods is too high. No one will be able to buy it. They will not able to produce anything much anymore. And they might downscale their business. And in the end, they might lead to getting out of business. And on the other hand, it might actually lead to a bank run. A bank run is a scenario whereby all the citizens go to the bank and tries to withdraw the money at a rate whereby it is widespread, where everyone actually does the same thing. Now, in terms of bank run, not all banks actually has that much amount of money to be given out because some of the money is actually being loaned to other parties or individuals or actually businesses. So due to this, bank may eventually run out of business and thus led to a bank run. And not only that, all of this that is been happening after hyperinflation occurs, they will enter into an economic crisis and also recession. So hyperinflation is actually a much more, I would say, a much more rapid way of inflation, and it could actually lead to unreversible damages that we may see in terms of examples here. Now, first of all, hyperinflation actually is a scenario whereby the price of goods rises super rapidly in a short period of time. So one of the cases that I would actually suggest to look into even more detail is Venezuela. Due to Venezuelans' political and also economic situation, whereby somehow it is mismanaged, Venezuela inflation actually spiked after Maduro's election, and it has risen up ever since. And it has actually attained 1.3 million% of inflation in a short period of time. This is one of the best examples to explain hyperinflation. Now, due to the rapid rise of goods, you can see that a normal Venezuelan citizen would actually need this much of stack of currencies in order to buy a few tomatoes in their country itself. So this is the degree of how a hyperinflation could actually damages your economy. And not only that, another significant factor of hyperinflation, which could actually lead to, is loss of faith towards the local currency, whereby you need so much of your local currency to buy a single good where it becomes worthless and it has lost in its value and it has lost its faith in terms of the citizens. So it could actually lead to something like this, where we could see here during the Germany's hyperinflation era, whereby their currency is worth nothing, that you could actually play it on the street itself. So this is the case of hyperinflation. Now, one important question is that how can actually interest rates help to prevent all these scenarios from occurring? Now we need to dive in deeper and look at the benefits of a controlled interest rates, whereby it will help to regulate two things. Number one, spending. Number two, lending. In terms of spending, interest rate could actually help to regulate spending in terms of increasing or decreasing the rate of spending. And in this way, we could actually control the price of goods. On the other hand, in terms of lending, it could actually help to increase or decrease lending activities. And after that, you could actually control the rate of business activity. Thus, interest rate is actually a very important tool to be used by the central bank, and also one of the most powerful tools that we could have right now. Now, to understand how interest rate could actually help to regulate the economy to maintain its stability, we're going to look at two scenarios. But we're going to look at scenario number one, whereby the inflation is actually quite low. In terms of low inflation, it could actually lead to slow economic growth, and spending might be lower, and at the same time, wage growth will be lesser. Thus, in this scenario, central bank would actually try to manipulate the interest rate by decreasing it. When we decrease the interest rate, it will actually lower two things. It will lower the deposit rate and also the lending rate. Now, let's take a look at the lending rate first. Now, when we actually lower the lending rate, more businesses or individuals will actually take loans because the interest rate is actually quite low. And when more businesses or individuals actually do that, this will actually lead to rapid business expansion. And when you expand your business, of course, you will need someone to help you in your business. You will actually hire more people. And this will actually create more job opportunities in the market. When more job opportunities is in the market itself, then more people will actually got a job and they will have more cash in their hand. So when they will have more cash in their hand, this will actually lead to higher spending eventually and lead to higher inflation in the future. Now, same thing goes to lower deposit rate. When the deposit rate is actually lower, lesser and lesser people will actually put their money in the bank. Most of them, or maybe a portion of them, will be more willingly to take out the money from the bank and keep it in their hand. When they have more cash in their hand, they will actually lead to higher spending. And when more people spend, this will actually lead to higher inflation. So as we can see here right now, when the economy is actually undergoing low inflation scenario, central bank would actually decrease the interest rate itself. However, right now we are currently embracing a high inflation scenario. Post-COVID right now, everything else in the market is actually getting more and more expensive. So what will the central bank do? First of all, the central bank will actually increase the interest rate, whereby it will lead to higher deposit rate and also higher lending rate. In terms of lending rate, when the lending rate is actually getting higher, fewer businesses or individuals will actually take loans. And when that happens, business expansion may slow down eventually, but it takes time. And when business expansion slows down, the number of job opportunity in the market will decrease over time, and thus leading to a slower job opportunity or job growth, and eventually lesser and lesser people might get job in that sense. So due to this, as lesser and lesser people got a job at an easy pace, thus they will have less cash on their hand, and this will lead to lower spending, and instead it will become controlled inflation. That means the inflation, which is previously quite high, it would actually decreases into a control rate. Now, at the same time, when the deposit rate actually gets higher, more and more people will be willing to put their money in the bank itself. And this will actually lead to lesser cash on hand, and this will eventually lead to lower spending and a controlled inflation. But right now, as the inflation is quite high, why does the central bank wants to control it? Well, when the inflation is too high, then it might lead to recession. Price of goods is too high for people to buy, which may eventually lead to closure of businesses, and it erodes spending power. So in that sense, what is actually the healthy rate of an inflation? Now, inflation normally, as a consensus or as what I have surveyed so far, central bank would actually like to keep the interest rate at a stable rate in between 2 to 4%. 4% might be too high, but some of them may actually keep at a higher spectrum. But generally, 2 to 4% in between this rate is actually quite healthy for the economy. You will need some inflation in order to ensure stable economic growth, stable wage growth, and also stable spending. And not too low, because if it's too low, then wage growth will be slower, and eventually everything else will slow down and at a pace whereby it is not favorable. So in terms of interest rate and also inflation, both of these always come hand in hand with each other, and they are mortal enemies. Now that is the end of part 2 to our 4-part series of inflation, interest rates, and the economy. Do subscribe to ZFX on YouTube and stay tuned for more.